All right, so now we're going to talk a little bit about inventory errors, and those are the final problems in this chapter, chapter 7 study problems. And so, again, going to do just a little bit of high level talk about it. Now, these errors we're talking about are really arising, the pattern of the errors are arising under a periodic system. So, this whole how how things will affect purchases and ending inventory, how we're talking about here in these problems, it only pertains to the periodic method. Um, Nonetheless, you're like, well, then why teach that? Because not many people use periodic, because it really helps you think through how errors in general can bleed over into numerous things. And the part that makes this one so interesting is that because we are under a periodic system, we are deducing cost of goods sold from our count of ending inventory. So when I'm locking this under the periodic method, what's going to be very paramount to understanding how to figure out these error problems is knowing this periodic system inventory equation, where we have the beginning inventory, we have net purchases, that gives me goods available for sale. And from that, I subtract my ending inventory. And remember, under the periodic method, this is really established through a physical count of inventory. And don't think that just if you use perpetual, you don't have to do a physical count. You do. But at that point, your physical count under the perpetual system is to establish shrinkage. Here, this count under the periodic system is to establish cost of goods sold. So we can have inventory errors in two places. One place that inventory errors can arise is a mistake in recording purchases. So this is an error in purchases. Did we incorrectly include a purchase? Did we exclude a purchase we should have included in this period? And then the ending inventory error is an error in count in terms of dollar values. So maybe we're incorrectly including some inventory that shouldn't be in there, or we don't have some inventory that should be there. And as you can imagine, a lot of these errors can revolve around issues with consignment, FOB shipping versus FOB destination, and the same as well in purchases. So as these things are affecting different portions, you have to understand what the balance sheet effects will be versus the income effects will be. So in terms of a balance sheet, we're going to have really two errors come up in purchases. Well, if you think about what happens with purchases under the periodic method, we are debiting purchases and crediting accounts payable when we buy that on credit, which we assume we do in these problems. This increases assets and increases liabilities. So if we record this when we shouldn't have, we're going to overstate purchases, but really, we're going to talk about why we don't care about that so much. But really, the account that we're more worried about is the liability that we shouldn't have credited yet. So we're going to overstate liabilities. The ending inventory count, this is going to be an error in setting how much inventory should be there at the end of the period. And so it's going to be an issue with our debit here to inventory. And remember, we're under the periodic system. So we have a lot of other accounts here. We have the purchase discounts. I'm leaving some space there purposefully. Purchase discounts, purchase returns, purchases, freight, and crediting out our beginning inventory. And this is a little important to understand. I mean, it's a visual way of understanding how our net purchases, which are tied up in each of these accounts, these four in particular here, right? Our net purchases will affect how much we calculate cost of goods sold as well our ending inventory count will affect it. So when something is affecting goods available for sale and also ending inventory, it will ultimately have an issue in cost of goods sold. These are my balance sheet effects, and the calculation of cost of goods sold from all of this, which we would put in right there, that's why I left the space, is also affected as we subtract ending inventory from goods available for sale and determine how much cost of goods sold I should have for the period. So I want to apply this to example 6. And for each of these, this is very similar to some of the stuff we did in the second chapter on the first exam when we're looking at, all right, how much are assets overstated or understated, liabilities, equity, and net income. So for one, Ptolemy recorded a purchase on a shipment of inventory, sent FOB destination. The goods are still in transit. So they're still in transit. That means that they're not physically present on the premises. They're FOB destination. So that means they will not be our inventory until they reach our place of business. They're still in transit, so they haven't reached us yet. But Ptolemy recorded a purchase on the shipment. So should they have recorded that purchase? And the answer is no. So I'm going to do my work over here, laying out the periodic entry as a sort of template to follow, or the periodic equation. So for this particular problem, we said they recorded a purchase, but they shouldn't until it reaches the destination. It's still in transit. It hasn't reached us yet, so we overstated our purchases. Now, for this particular problem, there's no indication that beginning inventory had an issue. If we take something that has no error, add something that's overstated, our goods available for sale are overstated, and our ending inventory. Now, a question as to whether this inventory was included in our ending inventory. Now, they did record this purchases, accounts payable, right? They shouldn't have. But remember, the ending inventory is a count. It is not, it is just established by what we count and put into as the number that should be what we want for our ending inventory. If we assume this inventory was not included in the count, was not counted because it's FOB destination and in transit, it would not be present in our ending inventory. But that's okay because it's FOB destination, it's still in transit, it should not be in our inventory. And so if it wasn't included in that count, there's no error. Then we have cost of goods sold coming in, something that's overstated minus something with no error would lead to overstated cost of goods sold. Right. So this purchase brings up an issue with liabilities because we would debit purchases, credit accounts payable, and therefore, in number one, liabilities are overstated. Here's where we'll determine whether we have an issue with assets or not. This is the only place, the ending inventory is the only indication for asset error. If there is no error here, then there's no error in my assets. But my cost of goods sold is overstated. And if I have too much expense, I'm going to have less net income. And then finally, remember that whatever happens to net income in this year is going to be what happens to equity because we're going to close that into our retained earnings account and that will understate my retained earnings. So you look at this guy for the liabilities, this one for the assets, and this one for net income, if you want the short version. The longer version is you have to remember when you're working this entry, the reason why we care about the overstated payable but not about the overstated purchases is these overstated purchases are just going to be closed out. So the error will no longer be in purchases. And we're going to count the inventory that is on our premises. That's that error in counting. And whatever errors we might make there will then also influence the cost of goods sold. So cost of goods sold ends up bearing more than, basically whatever errors might have been in purchases. And then if there are additional errors in inventory, it considers them both. Let's look at number two. It says Zeitgeist does not record a purchase, but includes some inventory sent to it on consignment in its final inventory account. So someone sent goods to Zeitgeist to sell on their behalf. This is not Zeitgeist's inventory, this is consignment. And so that is not Zeitgeist's inventory, no, nor should it record a purchase. So it did not record a purchase, but it did include it in its inventory. Once again, there was no indication of an error in beginning inventory. The purchases are correct as well because we didn't record a purchase. So our goods available for sale have no error. But we did include it in the inventory count, so we overstated our inventory. And when we subtract an overstatement from something that has no error, then we get something that is understated. So in this case, we have no errors with liabilities. We do have an error with our assets because the count was overstated. This forces an understated cost of goods sold. So that means my net income, since I'm subtracting too little cost of goods sold, is overstated. That will feed into my equity, which was through closing entries and the retained earnings account. And there is no error in liabilities. Let's keep going. Number three, they failed to record the purchase of inventory sent FOB shipping. The goods are still in transit at the end of the reporting period. So again, assume was not counted because it's in transit. So it was not counted in my final inventory count. So we're going to go through the equation one more time. There's no effect here. The purchases, it did not include a purchase, not record the purchase. It was shipped because it's in transit at the end of the period and it's FOB shipping. We should have recorded that purchase as soon as it was shipped. That's when title transferred. And so our purchases are understated. That creates an understatement in my goods available for sale. Then I need to subtract off the ending inventory, the account. It was not included, not counted. It should have been. And so my ending inventory was similarly understated. And these would be by the same amounts because we're talking about the same dollar value of inventory, both on the purchase side and on the counting final inventory side. So when I subtract something that's understated from something that's understated by the same amount, there's no error. Okay, no error to cost of goods sold, but we do have errors elsewhere. We have errors in our asset accounts and our liability accounts. We have understated assets because we didn't include it in our final count. We have an understated liability because we should have recorded the purchase and credited a payable, but there's no effect here, nor is there one here. So I'm not going to worry about number four, but I do want to talk about like every time I said, hey, there's no error here in beginning inventory. Don't worry about it. It didn't indicate any error in beginning inventory. Usually, what happens, how an error can get into beginning inventory is if we're doing like an analysis of a company over time. Each one of these was a different company for a different, just one period of time. If we look at a company over time, say, for example, this, if this were year one, year two, year three for the same company, well, there's no ending inventory effect here, so there wouldn't be in the next year as a beginning inventory. However, in the second year, if we had overstated ending inventory and this was a third year for the same company, the overstatement here would be still overstated here because ending of the prior year and the beginning of the next year or the current year, those two things are the same. So if we don't catch an error and we record our ending inventory as overstated, it's still going to be overstated the next year when we open our books again. And I'll look at the last one, which is a 2-year piece. Avery Brewing, during 2 years, 20x2, 20x3, investment, blah, blah, blah. All right, so look at the errors here. They failed to include in transit FOB shipping point inventory valued at 50,000 in the ending count. So it's FOB shipping point, $50,000, and they failed to include it. It was included in the purchases account for 20x2. All right. The goods will arrive on January 3rd, 20x3. So it's 20x2. They haven't arrived yet. It's FOB shipping. So we should have recorded a purchase and we should have included it. So they didn't include it in their final count, but they did record the purchase. And again, we'll just do the inventory equation for periodic system to give us the roadmap. All right. So in 20x2, that's the first year we're looking at. So there can't we don't have any indication there's an error in beginning inventory, so there isn't one. For the purchase, they did include the purchase, so that was all right. So there's no error there. There's no error in gaffs. Ending inventory, they failed to include it, and so that understated the ending inventory by 50,000. If this is understated and gas is on point, then our cost of goods sold will be overstated by 50. So for year one, these are the errors that we record for assets, liabilities, equity, net income. We have an issue with assets. They're understated by 50. There was no issue with purchases, so there's no issue with liabilities. No accounts payable running around that are problematic. Cost of goods sold is overstated. We overstated an expense, which would understate net income. And because we're going to close this errored net income into retained earnings, it brings my retained earnings to an understated amount of 50,000. So now let's talk about the second year. Remember, the very first part I had talked about, well, we're rolling into 20x3. If we haven't corrected these errors yet, then the asset is going to carry over into beginning inventory of the next year because my ending inventory will still be understated I'm sorry, overstated. No, it is understated. I kept looking between those two. It's understated by 50,000. All right. Let's see if they made any other errors. It says they included inventory valued at 30,000 that had been consigned to it for sale in the ending inventory account. So this would overstate my ending inventory by 30,000. It doesn't mention a purchase. We'll assume not recorded as a purchase. In 20X3, it included a purchase of $70,000 in inventory that is in transit FOB destination. It hasn't come to us yet. It was so it's destination. That means we don't have title to it yet. We should not have included this purchase. We overstated purchases by 70,000. If it's not at our destination, assuming we did not count it, we did not include it. All right. So if we overstated our purchases here, well, now we have these two errors washing out. It would, if we add them together, we would be net overstated by 20,000. Right. So basically, this reset a lot of the understatement and then brought it forward to an overstatement of 20. If we didn't include the in transit, right, that's okay because it's destination, but we did include this, that's a problem. That's overstated by 30,000. And so if we take the difference between those two, something that's overstated minus something that's even more overstated, we're going to have an amount that is understated by 10,000. So now let's walk through the entries. The same ideas apply. This is definitely the amount my liabilities are overstated by because of that purchase recorded. This is the amount that my assets are overstated by. My net income, we have an understated cost of goods sold, an understated COGS. So we're going to have an overstated net income for the second year for 10,000. Be careful with this though, because if we're talking about retained earnings, which is really what's been understated here, think about the retained earnings balance. It is understated by 50,000. We are now going to close net income that is overstated by 10,000. So the resulting retained earnings will be understated by 40,000. So this retained earnings account starts accumulating the errors in net income over time into itself, as long as the errors aren't being reset. Right? And that is the pattern of errors. This one for 20x2, this one for 20x3.